ECB. ECB. All right, let me go get that coffee. We got ECB in 14 metric minutes. All right. Bum, 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 bum. Bum, 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 bum. Guten Morgen. Yeah. Well, my coffee's weak this morning, huh? All right. Please fill out the poll. Let's get a sentiment test. All right, I guess we'll get going. All right, welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with TRADARS, The overriding goal of planning our trades in advance, because trading is risky, not appropriate for everyone. Your past performance, good or bad, not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Good morning. My name is Wayne. I salute you. Hey, we got this thing called ECB interest rate decision coming out in just a couple of minutes. Well, a few minutes. So let's just focus on that today. We're going to use traders.com for the fundamentals and the technicals. I use Traders Way for execution because they're an ECN and they're good people. Yep. But get yourself an ECN ASAP. ECN ASAP. BANANAS. Go on the fundamentals here. Okay, ECB has inflation coming down, and they have told us they are cutting interest rates. At first fairly quickly, and then over time a little less so, if you want to visualize it. Okay, between now and later, we should be between 2.65 and 2.15 at the ECB. What's the current rate? So, boom, 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 boom. Bada bing, bada boom. We'll go check and see if there's any vol on this that's providing reliable, repeatable patterns. And there is vol. Okay. And check this out. You see something that's interesting? Well, actually, a couple of things. There's no reliable, repeatable pattern if they cut. That's the first thing. What's missing here is the biggest thing you need to notice. The second thing, if they don't do anything today, which I don't think is the case, but if they don't, there's no euro-dollar trade. There's no euro-dollar trade if it's up, down, or sideways. Well, hell's bells. Now, does it create vol? Probably. That's one thing. Is there a reliable, repeatable pattern? No. Does it mean it's not tradable? It just means there's no reliable, repeatable pattern. Interesting, huh? So it's a level of risk that you need to prepare yourself for. Okay, so markets already started selling this around the implied range here, and then there's an applied range here. Okay. So you could, oops, let's do this in black. You could get a scenario like this, or a variation of it, huh? Maybe, Arve, maybe that is also one of the possibilities, Arve. You're saying that there's no reliable, repeatable pattern because maybe we don't have the data. Well, I just can't prove it no matter what. I don't know if that's true. I'm not saying that's true, but it is possible. But nonetheless, based on what we have, what we know, if you want to think about it that way, is that I can't prove a reliable, repeatable pattern. Therefore, it's risk. Okay? So one of the things that I'm pointing out here is if you had this opinion that you just shared with me yesterday versus just making it up now, if you felt this way yesterday, this was the trade. Yeah. No, but like I said, I don't know off the top of my head, Arbe, but you're right. If we're lacking the data because maybe it hasn't happened in years and years and years, then I don't have the data. But then, therefore, I can't tell you what the market's likely to do if it's rare. Right? It's still a level of risk that people should be prepared for. Yeah. Right. But this is how you should have had it set yesterday. This is what I have been teaching for 100 years now, right? That yesterday you should have had today's plan, not now. You can't just show up for the ECB meeting and you're like, I'll figure it out. No, that's not how you're supposed to be doing it. Okay, let's move over. Now, like I had shown in the past, there isn't a reliable, repeatable pattern based on the data that I have for euro dollar to do anything consistently. But I would agree with you. If they cut interest rates, it's probably bearish for the euro. Okay, makes BMWs cheaper. So it's okay to have that point of view. So what you would do here is you would go to indicators, you would put your bias pivots in bearish mode. Okay. And you had your selling opportunity already. Now double check what time frame that is, monthly. You can go weekly. Okay, so once again, there's the whole bearish point of view. And so let's get to the news. So we're at 2.9. $2.9, 2.75. Cool. Nice. I thought I had 2 pages open. Oh no. Where's the other page? Well, this isn't the one I wanted, but anyways, let's find it. Go to the scalping tab. And scalp on Aussie dollars, scalp on Kiwi dollars. Okay, looks like dollar strength is what it's thinking. So euro dollar down, I guess you could throw into there. I just can't prove it. So just using basic price action, right? This is your sell zone. if you're going to use price action. Right. Just like this lower low printed resistance in the future, new lower low, support becomes resistance. So we'll see what happens here. Now we have GDP coming out in a few minutes. What an interesting morning. Arve, the press conference, we have our US GDP and then we have the press conference, right? So, we want to know what they're going to broadcast or signal to us about future cuts, right? And so, of course, we already have that plotted out, right? But we need to see if they're thinking about the glide path changing. So again, if I go to fundamentals and I go to central banks, if we were asking them questions at the press conference, we would ask them about their inflation forecast and whether this is on target or not. Will this be adjusted in the future? And therefore, the glide path of interest rates. Okay? And it looks like they're going to, need to cut sometime in the future, like the next meeting, they need to cut one more time. But we're getting to the point where they're going to drop to pretty close to 2.0 by the middle of the year and then pause until the end of the year. So we would ask them questions about, is this still their base case scenario? And, how confident are they in this drop here in inflation? And you can see they already expect inflation to rise again in the future, and that's why they have it stuck here. Okay, maybe you could ask questions of like, is getting inflation to, by the middle of the year, is that still on, still realistic? And then why is this going to go up at the end of the year? What's happening there? Those are the kinds of questions that you would want to ask. So now only 10 and a half minutes until the next major news. That's it, brah. That's it. I'm gonna put this back over this way. Yeah. GDP 9 minutes and 50 seconds, and much more tradable than the ECB interest rate decision. Isn't that cool? These are the reliable, repeatable patterns around United States. Okay, so let me end the poll. Market feels like, you guys feel like Euro's coming down. Okay. Well, let's see. If GDP is bad, we'll call it bad. Slow, like less productivity is bad. So let's just call it bad. Euro dollar will go up. It's a scalp, a spot, and a swing. Now, if it's greater than that, right now, it looks like the opposite. Euro dollar comes down. Now, this seems topsy-turvy backwards. But if GDP is high, the Fed can't cut. And therefore, that's bad. if productivity is bad, the Fed will need to cut, and that's good. So right now we're good is bad and bad is good. Dogs are living with cats. Superman is evil. And then after all of this, ladies and germs, then we got the ECB press conference. Oh, all right. Why the risks in today's US GDP report are tilted to the downside and maybe deeply. Canadian dollar is trading steady after Bank of Canada, Scotiabank. Breaking. ECB lowers key rates by 25 basis points in January as expected.
Eurozone ECB main refinancing operations rate in line with forecasts, 2.9%.
US dollar mixed versus majors as markets hold ranges, Scotiabank. Austrian economy stagnates in Q4. So when you look to the left here, 6 minutes, until United States GDP. Okay, there's also continuing claims, right? That's pretty normal. It's nice, right? Cool thing is, it'll start flashing in the last few seconds, right, to keep you involved. Now, I don't think it's doing it, but there's supposed to be pop-up warnings and stuff, but I don't think that's happening. So I've spent so much money on this, I don't want to fix it. If it doesn't want to work, then walk away. Yeah, that's right, David. You know, up for a bit and down for longer. I like to look at weekly for that kind of stuff. So like I had weekly gold up. Let's move all this around. Wow, I got a lot going on here, right? I had weekly gold up. Was it? I guess it was here. Yeah. And so when you look at the markets from a weekly point of view, right, what's the goal? You're trying to ride these moving averages, plan A, plan B, although I very often use the 8 after a cross, not the 21. So like a cross here, and then here's the 8, but whatever. So really I could have it a little bit higher. Let me do it that way. Something like that. That would be my plan A and plan B if I was a bull. Now, it's weekly, right? So when it drops like a ton of bricks for 2 or 3 days, smaller time frame traders freak out. And meanwhile, it's just a dip for a bull. And they're like, oh yeah, look at that. Gold's down $35. Good, buy it. Right? And that's it. That's all that's happened. That's what happened. It came down, hit the 5. The other way of looking at it is using Fibonacci. If this is bullish, it's not likely to make a lower low. If it made a lower low after a double top, bulls are in trouble, right? So really the other way of looking at it is you go from the 50%. Let's take a different color. And I'll go back to using the box here. So your real risk is you want it to come back, let's say 50%. And that's probably 50%. So you get really interested on the 50% pullback with the assumption is not likely to make a lower low. But if it does, you got some concerns. And here's what happened. Now you're like, well, Wayne, I don't use Fibonacci. Okay, use weekly pivot points. It probably was pretty similar. But the whole idea is if you want to be a bull, you want to see red candles. And David points that out. Correctly. I agree. I concur, sir. I concur. Pound edges lower in range. Scotiabank. Breaking. ECB cuts key rates by 25 basis points in January as forecast.
Oil prices steady. Trump tariffs, hawkish Fed in spotlight.
See, those headlines just came out in the last minute. All right? Well, Richard, they turned hawkish last meeting. So we already knew that. What's up, Chrissy? It's Mr. Bossman. Thank you very much. Okay, I'm going to turn the reversals off. I just want to clean. Yens are coming down. Great, great, great. I mean, let's just take a look at them. That's all on schedule, right? We've been that way for quite a while now. Right? Kicking off the moving averages, coming down just like we had planned. We can look at this one. Look at that, right off of our bearish sell zone. And check it out. Whoa, 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 check it out. Look at that. Okay, again, this is the entry zone if you are a bear. Okay, and this is the aggressive target, 106.7863. That's the target. Whoa, whoa, whoa. Yeah, Dr. Chris. Well played, sir. Well played. Yeah, good comeback. Look at, we hit it. We hit the target and turned green. Shut the back door. Oh, the GDP came out. The GDP. Look at that. Just crazy accurate. All right, GDP. Disappointment. That's so good. The Fed's going to need a cut. All right, so disappointing news is fantastic. We went from 3.1 to 2.3. That's terrible, which is good news. We will see. Oops, if I can get my drawing tool. All right, interesting. Beautiful CAD yen play, though. Oh, my God. All right, let's take a look. And let's go to the buck. Okay, the U.S. economy is slowing down, huh? Yeah. Okay. So we're very bearish there. We're very bearish here. Okay. Looks like we did a little spinning top up into the 5 EMA. Should make a lower low, then come all the way back up to the 8 SMA, and then a new lower low after that. Cool. Cool, man. Okay, so all of that's coming into play. Let's now look specifically at your row. Right now we're just bouncing around. I wonder if that's our implied range.
United States personal consumption expenditures. Prices, QOQ, climbed from previous 1.5% to 2.3% in 4Q. Breaking, US GDP grows at an annual rate of 2.3% in Q4 versus 2.6% expected.
U.S. initial jobless claims 207K versus 220K estimate.
US Q4 advanced GDP plus 2.3% versus plus 2.6% expected.
Euro US dollar pairs losses as ECB cut deposit facility rate by 25 basis points to 2.75%. United States initial jobless claims 4-week average declined to 212. Neat, huh? Such a neat thing. All right, so anyways, so euro dollar spiked. And based on what we talked about before, let's see, the range from the 1 hour, 104.2. So 104.20 and 104.38. 104.20, 104.38. 104.20, 104.38. 104, 18, 19, 20. Look at that. All right, and 104.38 is 730. 104.38. All right. So based on what I showed you before the news, what I did, if you remember, we had this range and I drew it like this. You remember? So this is that first number based on implied volatility. Is anybody impressed? Now, to get that number, it doesn't look at support and resistance. You might just say, well, that's this, that, or the other thing. No. To get that number, okay, we look at every Thursday for euro dollar this time of day. This has nothing to do with the news. This has nothing to do with support and resistance. This has nothing to do with technical analysis. And we came up with that number, which is right here, 104.20. 104.20 is right there. That's your sell if you're a bear. Oh, my God. So if you're an options trader, you're used to implied volatility. If you're a spot Forex trader, you're probably not so familiar. But, you know, Rich is like, because 104.40 is resistance, but that's not what it is at all. Yeah. Right? It didn't look at tops and bottoms, and it just looks at the range, the Thursday range, euro dollar on the 8th hour. And it's a rolling 1 hour, 4 hour range. So this number was different an hour ago, 2 hours ago, 3 hours ago, 4 hours ago, 5 hours ago. Okay, and this one would have been moderately different. This one would have been very different, right? Well, hope they're less liquid markets would be one thing, just because less people have the expertise of, like most people would know an Arabica bean if they were chewing on one. So it's just, although it's a big market, that's not what I'm saying, but it's not big relative to the US dollar, right? So what we're looking at here, guys, is like this idea that, if the economy is slowing, and notice that weekly jobless claims were slightly lower, but people might take that as additional good news. If the economy is slowing, inflation is likely to slow as well. Okay. $103.91, 103.50. So 90 and 50. 103.90, 103.50.
Breaking. US GDP expands at an annual rate of 2.3% in Q4 versus 2.6% forecast.
Jobless claims dropped sharply in latest week. All right, so using our implied volatility tool, before we even hit the bottom, it's the implied hourly bottom of the market. Implied. We had this mathematically before it did it. But the implied low was 103.91. Look at the low. Look at the high. Before the news, it's 1 pip, within 1 pip of accuracy of top and bottom. Is anybody impressed? I mean, seriously, right? Anybody interested in adding implied volatility to their daily analysis? Yeah. So like David Pegler said, oh, well, if you're a bear, you want it to go high. So that's a plan A. Sell it right up in there. Plan B, sell it way up there. Why? You sell high if you're a bear. Okay. Now, actually, nothing's really happened. We hit the bottom, then we spiked up, and then we came back down. Great. Volatility is non-directional. It's just considered as the average range, but it doesn't tell you up or down. But you can say, well, the upper bound is overbought, the lower bound is oversold. Okay. Well, and Brian, pivot points are a different way of doing implied volatility. No, Chris. Every day every hour I calculate all this data by hand. I use my abacus, right? And then I update the numbers manually. Yeah, you're right, dude. Without AI, you just couldn't do this. I mean, or you'd have such a big team that Like this type of information, even just 10 years ago, but certainly 20 years ago when I started, would only be available to institutional investors. Yeah. But you still have to trade. So like with my ETF, we have meetings all the time and discussions have to be done. And yes, we have this data, but we have to discuss the data, and then we have to look at the situation, then we have to look at the charts, and then we have to eventually make the trades. And we meet on Thursdays and Fridays and Mondays to execute our trades. Some trades have to go in, some trades have to go out, some trades are just treading water, and these are all decisions. But if you didn't have the data, okay, then you have a deficiency, I think is the best way of saying it. Thank you, Hope. Check out gold. You can do it anytime you want. I always say that, right? Like, if you guys are subscribers at traders.com, you can have access to all this data whenever you want. Just, you want me to do it for you? All right, but what if I don't do it tomorrow? Uh-oh, now you're screwed. Can't trade gold tomorrow. Wayne didn't want to cover it. But, yeah, I mean, that's so easy. Everybody's trying to please me, baby. Okay? All right. Seasonally bullish, technically bullish. I went over that this morning with our fundamental analysis team. We discussed it's neutral but tradable. But if GDP is falling, is CPI going to fall? Is PCE going to fall? Well, hails bells. Well, I do live events, Vensu, every day, every morning. That's the best way. I'm your economist. I also have a macroeconomics class that might be helpful. It's, I think, 16 hours long. It's good. I think it's good. What was I doing? Gold. Where was I going?
Wes, initial jobless claims rose to 207K last week.
I don't remember where I was going. So anyways, let's, something over here. Oh, I know what it was. So we did this morning where I'm like, okay, here's your opinion, okay, and match up seasonality with technical trends. Done. So look at all these today. And then on the flip side, okay, should you trade Nikkei? No. Should you trade USD yen? Yes. Should you trade Aussie dollar? No. Pound Swissy? No. Okay, Kiwi dollar? No. Aussie Swissy? Yes. USD Swissy? Yes. Pound yen? No. Euro pound? Yes. Kiwi Swissy? Yes. Kiwi CAD? No. You see how easy this is? So now you create your, let's say, your top 10 assets that you want to look at, and you already know the direction. So now your fundamentals are done. You're already done for that part today. Then you take that list. Okay, so now you know your bias, bullish or bearish. Even if it's only technical and seasonal, you still have things. You've narrowed it down from hundreds of possible combinations just down to maybe 10 things, and you know the direction of whether you're a buyer or seller. Then you can go to here and turn on just the ones that you wanted to do. So there was a bunch of Swissies and stuff, I don't know, and some yens, I don't know, just whatever it was. So you take that list that you just made, and then you put it there, and you know up or down already, so we'll sort through all that. And let's say you're like, yeah, sell, buy, buy. Yeah, and now you know, let's say you wanted to sell Kiwi yen. Okay, strength, weakness, opportunity, or threat. Well, this pattern is exhibiting weakness, weakness. So that's good, but the next leg is up. Is that an opportunity? No, it's a threat. So it is weakness, but what you were looking for is that. Now, it's coming down anyways, but that's not the pattern. This is not a prediction. Right? I hate it when people email me and say, I want to subscribe to your signals. I don't have any signals, son. There's some guy that's going to promise to make you rich for $50 a month. Go sign up for his signal service. When I signed up to go to Harvard, they didn't say, "Oh, we promise to make you rich." No, they're like, if you can frickin' pass this program, you're a tough son of a gun. That's what they said. Anyways, so this is not a signal up. It's the next leg and the pattern is up. And, well, the news came out and pulled it down. But it's already bearish. There's also other ways of trading this. But nonetheless, you can see this drop. And if you can't quite see it, this drop here is news related, okay? Not the pattern. And it's not, and I know it's not news related because if I was trading price action, okay, we would have sold much higher. So what happened is it was like up, news. But it's in the direction that we expected anyways. So if you had sold this yesterday, you got icing on your cake. Okay? Oh, yeah, you guys want to watch the press conference? Yeah. Okay. Okay. Yeah, TRADARS is about running your trading business institutionally. Even if you only got 10 grand in your account, doesn't mean you should trade like an amateur retail trader. Even if you only have a $10,000 account, I want you to make institutional quality decisions and then have an entire team. Right? Like an entire team. So I already spent an hour today. Well, it was actually shorter, but so today is the 30th. Okay. We have 1, 2, 3 performance coaching sessions already in the bag. This is the 4th one. Later today is the 5th one. All live. Then one here. And then I do FX Street tomorrow, 2, a 3rd one, and a 4th one. So 4 tomorrow. Although I think that's no, I guess that's right. Yeah, that's right. So anyway, 5 hours today, or 5 sessions today, 4 sessions tomorrow. Dude, like, it's insane, right? So for those that are trying to learn how to be a better trader, it's hours and hours and hours and hours and hours a day. But
watch live Lagarde's press conference.
A break below 153.35 for US dollar yen is going to be a bearish signal. Rabobank.
ECB press conference. Lagarde comments on outlook after cutting interest rates by 25 basis points. Pound sterling drops against US dollar despite moderate US Q4 GDP growth.
Euro US dollar price forecast. ECB delivers, US GDP misses. US gross domestic product jumps less than expected in Q4.
Portugal GDP growth improves to 2.7%.
Excuse me. I was trying to. Oh, here's the macroeconomics one. Somebody, who was it? Vensu? You want to do this one, this macroeconomics course? 1, 2. So we have 13 lectures, and I'd say they're a minimum of an hour each. Money supply. Let's see the one on business cycles. Yeah, hour and a half. So that's 20 hours if they were all an hour and a half. So I don't think it's 20 hours, but like I said, 16, 17 hours just on macroeconomics. Where are we now? Let's say I'll pick here. And where should we be? Productivity gap. And Jay Powell says overshoot. So he's like, fill the gap between where real GDP and potential GDP. And it should get slower, slower, slower. And then once we're clearly above here, then the Fed might raise interest rates. Okay? And so right now, they look at us in a recovery period. Right? Which is good. But what if you're an investor now? Well, right now, the government, both the central bank and the central bank and the central government, are adding monetary policy and fiscal policy. This is spending, money going into the economy to try to push all these things up. And it should last for years. Okay? Which means companies in the United States. See, there's the full employment.
Cool, guys.
And by the way, you know, if you do your Series 65, they expect you to have all of this stuff. The negative output gap, full employment, peak, trough. This is right out of FINRA exams and NASA exams. See, it's beautiful, right? It's nice, isn't it? Cool. I mean, it's nice. But let's get over to the ECB and listen to them, I suppose. YouTube.com. Yes, I like pretty girls. ECB. Oh, there it was.
In November. As in the previous months, the increase was expected and primarily reflected past sharp drops in energy prices falling out of the calculation. Along with a month-on-month increase in December, this led energy prices slightly
you guys hear
higher
okay?
on an annual basis, after 4 consecutive declines. Food price inflation edged down to 2.6% and goods inflation to 0.5%. Services inflation edged up to 4%. Most underlying indicators have been developing in line with the sustained return of inflation to our medium-term target. Domestic inflation, which closely tracks services inflation, has remained high, as wages and some services prices are still adjusting to the past inflation surge with a substantial delay. At the same time, recent signals point to continued moderation in wage pressures and to the buffering role of profits. We expect inflation to fluctuate around its current level in the near term. It should then settle sustainably at around the 2% medium-term target. Easing labor cost pressures and the continuing impact of our past monetary policy, tightening on consumer prices, should help this process. While market-based indicators of inflation compensation have largely reversed the declines observed in the autumn, most measures of longer-term inflation expectations continue to stand at around 2%. Looking at the risk assessment now. The risks to economic growth remain tilted to the downside.
US dollar softer after US GDP falls below expectations. Lagarde's speech. If trade tensions don't escalate, exports should support recovery.
Oil prices steady ahead of Trump's threatened tariffs on Canada, Mexico,
such as Russia's unjustified war against Ukraine and the tragic conflict in the Middle East, which could disrupt energy supplies and further weigh on global trade. Growth could also be lower if the lagged effects of monetary policy tightening last longer than expected. It could be higher if easier financing conditions and falling inflation
well above
domestic
normal
consumption
implied vol
and
levels.
investment to rebound faster. Inflation could turn out higher if wages or profits increase by more than expected. Upside risks to inflation also stem from the heightened geopolitical tensions, which could push energy prices and freight costs higher in the near term and disrupt global trade. Moreover, extreme weather events and the unfolding climate crisis more broadly could drive up food prices by more than expected. By contrast, inflation may surprise on the downside if low confidence and concerns about geopolitical events prevent consumption and investment from recovering as fast as expected, if monetary policy dampens demand by more than expected, or if the economic environment in the rest of the world worsens unexpectedly. Greater friction in global trade would make the euro area inflation outlook more uncertain. Looking at the financial and monetary conditions now. Market interest rates in the euro area have risen since our December meeting, partly mirroring higher rates in global financial markets. While financing conditions remain tight, our interest rate cuts are gradually making it less expensive for firms and households to borrow. The average interest rate on new loans to firms declined to 4.5% in November, while the cost of issuing market-based debt remained at 3.6%. The average rate on new mortgages edged down to 3.5%. Growth in bank lending to firms rose
9
to
o'clock.
1.5% in December, up from 1% in November, amid a strong monthly flow. Growth in debt securities issued by firms moderated to 3.2% in annual terms. Mortgage lending continued to rise gradually, but remained muted overall with an annual growth rate of 1.1%. Credit standards for business loans tightened again in the fourth quarter of 24, having broadly stabilized over the previous 4 quarters, as reported in our latest bank lending survey. The renewed tightening mainly reflected banks.
I actually did that already,
concerned
Chris.
About the risks faced by their customers and less willing to take on risks themselves. Demand for loans by firms increased slightly in the fourth quarter, but remained weak overall. Credit standards for mortgages were broadly unchanged after 3 quarters of easing, while the demand for mortgages again increased strongly, mainly because of more attractive interest rates. In conclusion, the Governing Council today decided to lower the 3 key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate, the rate through which we steer the monetary policy stance is based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy.
Hey, thanks for hanging with me today. I appreciate
We are not
that.
pre-committing to a particular rate path. And in any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. And we are now ready to take your questions.
Hey, don't forget, we have swing trading today, 4 p.m. ET.
Good afternoon. Thank you for taking my questions. First question is about the future. Where do we go from here? Are you still confident about the direction? Your fellow board member Isabel Schnabel said we're getting closer
Lagarde's
and
speech.
closer to the
Risk
point
of greater friction in
where you
global
need to have a
trade could
discussion
weigh on
about
euro
how much
area
further rates
growth.
can come down.
ECB's
Did you start
Lagarde.
having the discussion
Indicators
today?
Developing
And
towards a sustained
what's your
return
own
to our
view on
inflation
this
target.
point?
U.S. stocks may see initial strength on positive reaction to earnings news.
Change for your neutral rate estimate than in the press conference here. Why did you change the estimate? Why did you lower the midpoint? What is the significance, or if there is a significance, of this change?
Thank you so much for your two questions. First of all, I just want to remind you that by lowering by 25 basis points today our three interest rates, and particularly the DFR, we have now cut down by 125 basis points relative to the high level where we were. Number two, there was no discussion as to whether this decision was appropriate or not. It was a unanimous decision. So all governors supported the decision that was articulated by Philip Lane this morning of cutting by 25%. You will have seen in the monetary policy statement clearly stated that at this point in time, we are still in restrictive territory. And we have not had a discussion, because it would be premature at this point in time, about the point where we have to stop. We know the direction of travel. You've mentioned it in your question. And this is the direction that we will take, at which pace, with what sequence, what magnitude, will be informed by the data that we will collect in the coming weeks and months, and by the analysis that our staff will conduct. We are lucky that for our next monetary policy meeting in March, we will receive a projection prepared by staff, which will be informed by the economic environment as it unfolds, and we will have, in the meantime, 2 additional readings on inflation. Those are data points, granted, but a series of inflation readings are informing those decisions. On the on R-star, natural interest rate, you will be pleased to see in 8 days, on February the 7th, a publication by staff on the revision of the natural interest rate. And, you know, this is not something that we have discussed. As you know, it's a range, and it's a range that has, that does not give a guidelines or a destination. It's an indication, and it's in many ways a conceptual principle that is elaborated by a number of models, and that's what staff will publish and will comment upon. So you'll have plenty of it to elaborate upon.
The next question goes to Annette Weisbach of CNBC. Annette, please.
President Lagarde, thank you very much. I have a question on the economic outlook. You're saying that you're expecting that exports will contribute positively to economic recovery or activity. But if you look at the uncertainties in that world, how much do you think actually this is something which is realistic given the slowness in China, given the Trump administration? That would be my first question. And my second question is whether, given that bleak economic picture and also the disinflationary trend and these restrictive monetary policy stance, why didn't you discuss a 50 basis points cut? Thank you.
Well, I can reassure you right away, we did not even utter the two numbers 50. So 50 was not in the debate at all. And as I said, there was rallied support unanimously by all members of the Governing Council for 25 basis points. Your question on exports, it's an interesting one. We took the precaution in the monetary policy statement to refer to export as a potential engine for growth. Not the main one, but an additional one. And we took the precaution to say, if I recall, provided that there is no trade or additional trade friction, something along those lines. So that's in the economic activity paragraph. And then we talk about exports yet again in the risk section. And we clearly analyze the trade environment, the framework within which trade takes place, and the uncertainty associated with it as a potential risk. But obviously, there are rumors, there are statements, there are assumptions, but we don't have anything that is, clear, tangible, and can be inserted into the analytical work that staff does. So we will be looking very carefully at the numbers that come in, the information that sort of consolidates, and obviously staff will incorporate all that in the work that they are going to do for the March projections. I'm not sure that there will be, by March, enough certainty to actually be very confident. I think we will still be plagued by uncertainty in that respect, and there will be more to come. But as it comes, we will be taking that
This was a
into
unanimous
account.
decision.
And the next question goes to Mark Schroers of Bloomberg. Mark, please.
Yes, thanks a lot. The first one is on inflation. Your confidence in reaching the 2% target is very much based on the expectation that wage growth and services inflation will slow down significantly. That hasn't materialized yet. Services inflation is still around 4%. At what point in time do you need to see hard evidence in a slowdown in services inflation to continue cutting rates, let's say, beyond March? And the second one on a completely different topic. Your Czech counterpart yesterday said that his institution will assess including Bitcoin into foreign currency reserves. And US President Trump has backed the idea of a national strategic Bitcoin reserve. What do you think about such ideas? Is that something the ECB is looking into? Thanks.
Well, thank you very much for your two questions. Yes, we are confident that inflation will reach our target in the course of 25, and that's 2% medium term, sustainably so. And you are right that there is one particular item which is still resisting. The others are moving down. When you look at goods, when you look at non-energy industrial goods, when you look at subsets of all that, it's definitely moving down. And I have said in previous press conference that when goods are going down to 0.5, we're not going to expect that services will be at 2, because we would be clearly undershooting. But services, and in particular, if we look at the various underlying measurements, the domestic one, the one that strips out anything that has to do with exports, is still resisting. And that's actually gone up a little bit, because on services, we were at 3.9, we moved to 4. We're not data point dependent, but we look carefully at services. And we know that, those services are largely labor intensive, with or without contact. We used to have that distinction in the COVID time. We have less of it at the moment, but it is largely wage labor intensive and as a result wage sensitive. We try to measure and to understand wages as much as possible because it is so relevant for services. And all the indicators that we have at the moment are heading downward and are confirming our confidence that wages in 25 will be going down. Whether you look at compensation per employee, which is quite a useful and relevant indicator, whether you look at the wage tracker that we have, whether we look at Indeed, whether we look at the ratios of vacancy to unemployment, all of those indicators are heading in the same direction. We're not celebrating that, but we are taking note and acknowledging the impact that it will have on services. Some of you will remember that I've also, and we have focused on the distinction between the newcomers and the latecomers. We took, for instance, a particular review and deep, tried to have a better and deep understanding of those latecomers that waited for a period of time until they decided to hike prices. That is clearly the case for insurance companies, for instance, that do not increase their prices on a monthly or quarterly basis, but they generally wait until the expiry of a contract and then they hike prices. So we will be very attentive to how the latecomers, which did hike prices in January to March 24, whether this process under which they caught up with inflation is going to be duplicated this year again. We don't think so. And we do a corporate telephone survey, the result of which you will see tomorrow because we publish tomorrow. But our understanding from the corporate telephone survey as well, because we ask them, how do you see negotiations taking place? And when do you expect increases? All of that is heading in that direction. So it gives us the confidence that wages are on their way down and therefore will impact the price of services, and that we will see a declining movement in the course of 25. We don't expect, I think we say in the monetary policy statement that in the coming, the next couple of readings will still be resistant, if you will, largely because of base effects on energy prices. But from there on, we see this declining path in the course of 25. But once again, we don't look at one data point or one, it's not just compensation per employee. It's not just negotiated wages. It's the combination of it all because it's a complex matter, depending on member states, depending on collective bargaining agreement and their renewal, all of that. On this matter that you referred to and whether reserves of central bank should or could include bitcoins, I think there is a view around the table of the Governing Council, and most likely the General Council as well, that reserves have to be liquid, that reserves have to be secure, that they have to be safe, that they should not be plagued by the suspicion of money laundering or other criminal activities.
In 2025.
And your US dollar moves higher despite the rate cut from the ECB.
ECB press conference. Lagarde speaks on outlook after cutting key rates by 25 basis points. Lagarde Q&A. This was a unanimous decision. Lagarde speech. Risk of greater friction in global trade could weigh on euro area growth. ECB's Lagarde. Indicators developing towards a sustained return to our inflation target. US dollar softer after US GDP falls below expectations. Lagarde speech. If trade tensions don't escalate, exports should support recovery.
U.S. stocks may see initial strength on positive reaction to earnings news.
Watch live Lagarde's press conference.
What impact do you foresee? And second question, if tariffs are introduced, do you think monetary policy will have to adapt immediately, or is it necessary to wait for the impacts on activity? Thank you.
Well, thank you very much for your question. I'm comfortable with one thing. We are comfortable with one thing, which is to reach our target. We are mission-driven. We want that 2% medium-term sustainable, and we will do everything that is required in order to reach that goal. So, as I said,
she's smart. That's a great
to another
response.
colleague of yours earlier on. Under the baseline that we have, and with the data that we have received, we can comfortably indicate that we are directionally on this downward slope, pace and sequence of which will be determined by data and will be decided on a meeting by meeting. And for those who would like to have this solid forward guidance, it would be totally unrealistic to do anything of that nature, simply because we are facing significant and probably rising uncertainty at the moment. So this is what we have to do. And we continue to be guided by this sort of threefold analysis, which includes the inflation outlook, the underlying inflation, and the transmission of monetary policy. So are we comfortable doing what we have to do? Yes, absolutely, because we are mission-driven. The second question you had related to tariff. You know, as I said earlier on, for the moment, there is nothing that we can actually capture in terms of policy determination, in terms of numbers, in terms of scope, in terms of, you know, custom line items to understand exactly what is considered. When that happens, then of course it will enter into our assessment and into the macroeconomic analysis that is produced by our staff. But you know, it's far more complicated than it's this way or this way. It's inflationary or deflationary, depending on whether there is, you know, one set of decisions with variable rates around the world, rerouting of trade, whether there is retaliation or not. All we know for sure is that it will have a global negative impact. A global negative impact.
And the next question goes to Silvia Bazzoni of Class CNBC, the Italian TV channel.
Good afternoon, President. Good afternoon, Vice President. So in the statement you mentioned headwinds, and GDP released this morning, of course, were below expectation, especially for France and Germany. So is the recovery delayed, and how long will it take to come out of stagnation? And the second question you were mentioning before, since December, long-term yields have gone up significantly following especially Treasury sell-off. And this besides the economic divergence between the EU and the US. So are you worried, and how are you assessing the situation? Thank you very much.
Are you worried about what?
The yields that are going up.
Oh, yields.
Yeah.
Okay. So is the recovery delayed? First of all, there is recovery. I think that's the first thing that we have to keep at the front of our mind. We went from a very low 23 to almost double the growth in 24. Now, granted, it is not at potential yet, but it's certainly a recovery. And given the job market, given the real income increase, we have good reason to believe that consumption will pick up and will continue to support this recovery process that we expect to continue. We never talked about stagflation. Q4 was stagnation of growth, but it's one quarter. If you look at the whole year, it's a different story. So, recovery there is.
Yeah.
Stagflation there is not. Inflation is going down, and we have recovery. Will it be delayed? We shall see. As I said, it's a process that is ongoing, and that has been quite something in the course of 24. So the yield increase, whether you look at the short end or the long end
Euro
of
weakens against
the curve,
dollar as
yes,
ECB
it
cuts
has
interest
increased.
rates.
ECB
And
lowers
it's
interest
a
rates for
global
fourth
process.
session. Polish economy
been-
grows 2.1% in 2024.
Over across the world, and the euro area has not been spared of those spillovers. It's largely attributable to spillovers from the US, not only. partly because of energy prices, but also for other reasons. There is probably less of a downside risk expectation concerning inflation on the part of the markets, which probably explains partly this yield increase. But as I said, largely spillovers, partly Euro-specific. But it doesn't stop our monetary policy from transmitting quite materially. When I look at the decline of interest rates for corporates, the decline of interest rates to households for mortgages, it is really channeling through into the economy. And when I look, for instance, at the consumer survey and the intention to invest, there is clearly an added demand on the housing sector, for instance. So more to be seen on that front, particularly fueled by lower interest rates.
And now Olaf Storbeck of the Financial Times. Olaf, for you, please.
Thanks a lot. I have a few questions on the natural rate debate.
Not few.
Can you give us any idea of your views on how the ECB will decide when we are there? So conceptually, will you just take the mid-range of the staff forecast, or have you already discussed how to determine that? And do you have any views on the question, as we are getting closer to the level, wherever it is, will the reaction function of the ECB have to change in terms of, do you have to act more slowly, or kind of take more time to see how monetary policy actually works? Thanks.
It's a nice question. But let's face it. We are currently restrictive. We are not at neutral rate. This is a debate that is entirely premature. When we get closer to that, we will operate on the basis of a staff research paper, on the basis of the analysis provided by staff, and then that will help us determine how close we are and what our monetary policy stance should be. If you're asking me today whether we should go below neutral rate in order to stimulate the economy, I cannot tell you that. That's pretty obvious. We decide meeting by meeting on the basis of data, and we are not pre-committing to any particular pace. So how could I tell you if and when we arrive at this conceptual principle of the neutral rate, what we will do afterwards? This is going to depend on the data that we receive.
Stefan Rechlus of Handelsblatt. Stefan, please.
Oh, by the way, we will be also, I know staff is going to work very hard on models, but we will be looking at all sorts of information, intelligence, the famous reference to looking out of the window. We will also be looking out the window.
Thank you for the floor. Here I am.
Hi.
You had a dinner guest on Tuesday evening, which, if I'm not mistaken, was the first time. Could you walk us through the exchange with Ursula von der Leyen and what you talked about and how it feeds or fed into the deliberations of the Governing Council? And my second question, if I may, is on the withdrawal of the Fed from the NGFS. The timing was delicate, just days prior to Donald Trump taking office. Did this exit surprise you, either in substance or in timing? Did you expect it, and what does it mean for global cooperation of central banks? Thank you.
Well, thank you for your two questions. President von der Leyen honored us with her presence at dinner on Tuesday. She was not the first one to attend what I, very immodestly call the president's dinners. Pascal Donoghue, the president of the Eurogroup, had also attended one of our dinners. And it was a very rich experience, which all governors felt could be repeated with other guests from around Europe. So I was particularly grateful to the president that she came, despite the crazy agenda that she has. Let's face it, this week is particularly heavy for her, and she managed to come. It gave us a chance to understand better from her expose, her remarks, what exactly the Commission was going to focus on in terms of competitiveness, in terms of simplification.
See how the page updated
keeping
without
the goals,
refreshing the
being
page?
flexible on the approach. And I think that she was herself, but she can speak for herself better than me, pleased with the exchange that we had, because it took the form of her explaining the policies considered by the Commission
US dollar
in order to
Canadian
restore
dollar
the
trade
competitiveness, in
subduedly
order
above
to incentivize
1.4400
innovation.
despite US dollar slides after US data.
Lagarde's speech. There is no stagflation.
And
So see, if even if you're not watching the ECB speech,
so it was in
my
that respect
AI
really,
is.
Really an interesting dinner. And there will be more of those, as I have other guests up my sleeves, which I'm not going to disclose at this point in time. Now, you asked me a question about the withdrawal from the NGFS. The NGFS includes, I think, over 150 countries around the world. We are an active member of the NGFS. We actually provide the scenarios that are used by the NGFS and most members. And we see huge value in this multilateral, comparing of notes, comparing of scenarios, comparing of risks, comparing of policies. I think in this day and age, having a multilateral setting where these issues can be debated and analyzed is of great value. I'll stop here.
And the last question today goes to Elena Savova from the Bulgarian news agency. Elena, please.
Thank you. Good afternoon, Madam President. I have two questions. First, you mentioned rising real incomes. How far is this process gone comparing the levels pre-pandemic levels? And my second question is related to Bulgaria. Bulgaria is preparing to ask for extraordinary convergency report. Do you have recommendations for easing this process? And eventual extraordinary convergency report, would it be focused mainly on the technical criteria for entering the Eurozone, or it would take a more comprehensive approach about policies, about legislation again, like the released in June?
Right.
Thank you.
I beg your pardon because I missed the first part of your question. The second part I registered on Bulgaria, the convergence process and all that. But on the first one, what was it?
The real incomes.
Oh, real incomes.
Yes.
Okay.
How far are they gone comparing the pre-pandemic levels?
Yeah. Okay.
Pre-pandemic.
So on rising real income, it's a fact, and in many member states there has been a complete catch-up with pre-pandemic levels. What has been different from pre-pandemic levels is the level of savings. And the level of savings has increased, has varied over the course of time, but in net terms has increased. And we very much hope that if confidence can be restored, particularly in view of a degree of anxiety and uncertainty about European political development, for instance, that consumers and investors will restore their previous pattern of consumption and investment. On
Ding,
Bulgaria,
ding, 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 ding,
there
ding,
is a
ding, ding,
convergence
ding, ding,
process that is
ding,
well
ding.
advanced.
Markets are
We
open.
are
Yeah,
marginally
boy.
involved in the process because we do not pass judgment on anything else than convergence towards inflation, and we look at the fiscal position and the sustainability. But on those fronts, and from what I have seen and the discussions that I have had with the Bulgarian authorities, I'm confident that this process is going well, and the special convergence report that has been asked by the Bulgarian authorities will, I suppose, it's not my decision, it will be determined by the Commission, will proceed so that they can be a review of all the criteria, not just inflation, but all the criteria that Bulgaria has to satisfy. So I'm only giving you a partial answer because the rest can only be given by the Commission.
Thank you very much. That concludes our press conference today.
Started with
We'll
green
be
on the
back
screen.
the
We'll
6th
see
of
if it'll
March,
last.
And until then, I wish everybody all the best. Thank you.
All righty. This concludes the press conference. How do you guys feel? Was that good? Yeah, I think so. That was good. So thank you for being here. Thank you for your attention. Thank you for your loyalty. Thank you for being part of the Traders.com community. 4 p.m. we have the swing trading group. Don't forget that. So peace on earth. May the pips be with you. May your profits be above average. Have a wonderful trading day. I hope to see you later